Now, we're joined by Nick Gartside, JPMorgan Asset Management Chief Investment Officer of International Fixed Income, and James Barty, Bank of America Merrill Lynch, Head of Global Cross-Asset and European Equities Strategy. Two good titles there. Thank you so much for joining us. Nick, let me start off with you. How do you read China? Is it actually that the economy is getting much worse than expected?
Well, no, it's clear, deliberate attempt to ease, to support the economy, and it's part of the reaction against slowing global trade and, of course, trade tensions. It's absolutely the right policy that they're doing in China.
What about you?
Yes, look, the Chinese economy has been slowing. There's the risk of the US-China trade war. So, we've been arguing for some period of time that the right thing for the Chinese authorities to do would be to ease policy. This is just another step in that direction. And we think they'll actually carry on doing this because they need to get some stability into the economy as we go into 2019.
OK, what does it mean for renminbi? What does it mean for the trade?
Well, look, our FX strategists think the bias of the renminbi is to go down. We're looking for it to go the other side of 7 as we go into next year. But it's not manipulation of the currency. It's actually just the currency responding to a necessary easing of monetary policy conditions.
Nick, good morning. I really want to flow in here to how everything is interlinked right now. What's the correlations within the market? Is everything in lockstep centered around Chairman Powell's policy, or is it more idiosyncratic and distinct?
No, very much so. So it's clearly the Fed very much setting the tone in terms of global monetary policy. That does have a very big impact on a place like China. The other thing, though, to keep in the back of your mind with China is that as we get into next year, China enters global bond indices. So on the sidelines, there's this very big appetite to buy Chinese government debt, which will also be supportive for the currency.
James, take this back to like real investment. Excuse me, it can be cross-asset, it can be this or it can be the other thing. The fact is there's all these international relations, this international economics. What does it mean for placement of assets in the equity markets, in the American and the European bond markets?
Well, I think investors have been hiding in the US equity market so far this year because it's been the one market where you've seen very strong earnings growth, you've seen strong buybacks. And what I think we saw last week was that, it failed to break to new highs, and then we had the bond market starting to sell off. And a bit like in January and February, the equity markets initially ignored the move in bond markets, and then suddenly it's, oh, hang on a second, the US 10 years at 320. That's starting to, therefore, potentially impinge on our valuations, and the equity market has to pause for thought. And I think what we're looking at here is at least a modest pullback in equity markets until bond yields stop going up.
What can change? Can it change even, it was a pretty rapid, I guess, change of market sentiment. Will it continue along that vein?
Well, I think equity markets were blindsided by this because we were looking at everything else. We were worried about the US-China trade war, we were worried about Italy, we were worried about Brexit, and then suddenly the fixed income markets creep up along the sidelines and give us something else to worry about. My view is that the actual level of bond yields is not so much of an issue. It's more the speed and the amount of change. And I think it was the fact that we did, 40 basis points in 3-4 weeks that's actually spooked the markets. Until the bond markets settle down, it's difficult to see the equity markets catching a bid again.
Do you agree with that?
It is, and I think when you think of bond markets, a realistic year-end target, 3.5% for that 10-year Treasury, but we've got a quarter to get there, to James's point, so it will be a slower rise in yields from here. And when you think of bonds, yield is king. That's what will come out.
Do you look for basically more instability? Nick Gartside, it's real simple. It's been a hell of a ride, a hell of a bull market, and all of a sudden yields are competitive. Does that just flat out mean it's more unstable from here, more unstable?
It does. It means volatility probably shoots up from here. And again, it's a consequence of central banks globally exiting quantitative easing. It's a consequence of globally central banks shifting interest rates. That injects volatility back into markets. And to your point, certain bonds can compete. You're close to a 3% rate in terms of cash in the US. So that's a competitor, a decent competitor for other asset classes.